Hi everyone, my name is Michael Gentile. I'm a leading strategic investor in the junior mining space. I'm here today in London to speak to investors about my process of how I allocate capital in the junior mining sector.
Michael, good to meet you. We've not met, well, we met, I think, in Quebec briefly in the corridors.
It's our first live set.
First live set now, that's fantastic. So you are here in London. You're doing this as part of a roadshow, helping out some of the portfolio investments that you've got in your portfolio. And we're at the famous Army and Navy Club on Pall Mall. It's exciting. And it's very early in the morning, so do forgive us, folks. And this is the first day of many. What are you doing?
It's a 5-day tour. So
Right.
we're doing London, Paris, Geneva, Zurich, and Frankfurt.
Right.
And I've got 6 of my largest portfolio investments with me. And we're going to be talking about how I allocate capital in the junior mining sector. But I always think it's essential when you're giving a thesis on something to show a pragmatic, practical example side by side in parallel. So I'll be walking through my approach, how I allocate capital, how I pick junior mining companies, and I brought 6 of my highest profile investments with me on the road.
Right, and we're going to meet with them later.
Correct.
All through the rest of today. But do you think you've timed this right?
We picked this dates like 4 or 5 months ago, so I can't say I could take credit for the big move in the gold price, but it's been pretty good timing, yeah.
Pretty good timing. And most of those, well, so in terms of the metals that you're going to focus on, what are they?
It's a good mix. Precious metals, so it's a gold company, there's a silver company, a copper gold company, zinc, lead, silver company, so across the spectrum, but a primary focus on precious metals, which has been my focus the last 7 to 8 years.
Right. Well, let's talk about a little bit of looking back. Obviously, you're going to talk about the kind of investing thesis that you have across your portfolio, which is more than just the companies that you're showing off here in London. A little bit of background on you. Where's it all come from?
So institutional money manager. I started investing institutionally 24, 25 years ago. The first sector I ever covered was commodities, my first love. I started investing in oil when oil was $10 a barrel. Everyone said it was going to go to 5, and then it went to 140. So it gave me a real good lesson on contrarian investing, and that's stuck with me over the years. I always did very well in that cycle. So since that time, I've always looked for cycles where the sentiment is very poor, where I have a contrarian positive outlook for the commodity, and where you can get incredible value, where the sentiment is extremely poor. So I've been investing across all the commodities for about 25 years, institutionally for most of that time. And then 6, 7 years ago yesterday, I had twin daughters, so I had 5 girls under 8 years old.
Whoa!
Needed to take a time out from my life a little bit. So quit being an institutional investor, and that's when I started allocating my time full-time to investing in junior precious metals equities. I was very bullish on gold at the time.
Yeah.
Gold was very depressed. It was 2018, as you recall. The sector was on its knees, so I saw huge value, and one investment led to another. And today I'm a significant investor in about 25 to 30 junior mining companies. Okay,
well, let's maybe get into the thesis a little bit deeper if you don't mind. Contrarian investing, easy to say, very hard to do for most. I know some great people, some people have made a lot of money along the way, and they talk a good game, but they kind of feared to tread just in case. So in terms of what specifically you learned about contrarian investing, can you go too early?
Absolutely. So why most people fail in that is they don't have the duration or the staying power. So if you're going to be contrarian, by nature you're going to be early. Yeah. So you might put money in when oil's $10 a barrel, but it goes to $8 before it goes to 140. Yeah. So you're going to lose 20-30% off the top. Or you might buy in at $1,100 gold and it goes sideways for 2 or 3 years and you make absolutely no money. And you get paid, you get bored, other people making money in other sectors, so you lose patience, you throw in the towel. So you really have to build your thesis on a strong macro viewpoint, have conviction, and have long duration. If you don't have that, if you're trying to make money over a 3-month period, contrarian investing is not the way to go because you'll never time it exactly right. You will get good value, but you might have to wait several months or years for that value to be actualized.
Right. Okay. So you've got to have conviction on the thesis. So where do you get that data from? Because if I look back to the last sort of 5 or so years, and I guess 15 years in investment banking, not a lot of good data out there. And if I sit and listen to the CEOs of companies, I would probably be a very poor man because they're incentivized to speak a certain way. So when you're looking at precious metals, obviously the last 5 years, it took a long time to get to where we are today. The normal rules didn't seem to apply. Were there moments of doubt in your mind?
There was moments of frustration. I use the analogy. I was like a farmer that planted, seeds in 2018. The sun was shining beautifully every day. The rain, right amount of rain fell every single day, and no plants were growing. Yeah. And so that's why I actually planted so many plants because I had so much time to build a significant portfolio in the junior mining space. But doubt, no. I think data point's a good one, Matt. I think on gold, it's a monetary metal, so there's incredible data on government spending and debt and just fiat currency. So there's incredible data on that front. And so gold was a little easier than some of the other commodities, which are a bit more nuanced. You have to have a much more robust view on supply and demand.
Yeah.
My gold thesis basically started off, which has been talked about by many, many people on your show, which is just the rampant spending of governments, rampant amount of debt, inability to finance the debt and cover the interest costs on the debt. It's gotten way worse, way faster than I expected in 2018. So if anything, my thesis has been reinforced with more and more conviction since 2018. But the frustrating part is not making any money. I've never seen a call where I've been so right on the macro before, where it took so long for the market to wake up. The market's just waking up now, 7 years later, to these, to me, obvious signs that we've seen for several years that gold was going to take a more prominent role.
But so ultimately, the kind of quantitative easing was the solution here, but it also delayed things for you. Just the fact that it was a synthetic overlay on natural, historic kind of economic rules. So did he? I mean, he obviously toughed it out, and here we are today. Did you look at that as kind of lost opportunity cost? Were there other things that maybe you should have been in that delay? Or did you think, like, I'm in it, I've got to stick with it?
Yeah, I'm lucky or unlucky, I guess. I'm an investor with a lot of conviction. So I don't really look over my shoulder and see, how much the guys are making in NASDAQ, or what are they making over here? I have a thesis. I like to make big, large, concentrated bets. And to do that, you have to have a lot of conviction in your thesis and the companies you're investing in. So what keeps me up at night, it's kind of what you're asking, a sub-parallel here would be when the companies are not executing or my thesis is starting to derail. And that's what worries me. But if my thesis is intact, the macro is intact, the companies are executing well or better than I expected, I'm buying more and sleeping well at night. I don't worry so much about what Joe's making next door. It's a great point, though, because I think the late 90s and today is an excellent parallel. Late 90s was the dot-com boom. Everything that wasn't a dot-com was being completely ignored. So in the late 90s, it was pretty obvious that China was starting to consume massive amounts of oil, and their demand was growing exponentially. But the oil price remained very subdued because everyone was distracted by the shiny toy of dot-com stocks. Similar parallel to today, with the NASDAQ and the AI boom being so powerful, is I think this thesis has been quite obvious for everyone to see for several years, but they're making so much money on tech and AI that there's been no reason to go to a sector that was underperforming for many, many years. So you have to look at the context as to why a sector is not working. When I'm not making any money in a stock or in a macro call, I'm always asking, well, why are investors not seeing this? What is distracting them? What am I missing potentially? And in this case, I really think it's been too easy to make money in other corners of the market that investors haven't felt the pressure to reallocate.
But along that journey, obviously, we talk about. I'm coming back to this conviction thing because I'm a big believer in it myself. I call my own investing style lazy investing. I do all the work up front, and then I kind of sit back and wait for it to happen. But you've got to pick the right companies, and sometimes the right companies get starved of the oxygen of available capital, which has happened to a lot of juniors over the last 5 years, 6 years or so. I mean, 2020 is an exception, I think. And they have to wait it out. But likewise, the continual raising of capital, the cost of that capital, the dilutory effects of raising that capital, quite harmful. Eventually you kind of get there because if you believe the thesis. But again, it must have been sort of tough to kind of help with those companies and maybe cost you a little bit more.
It's a great question. So, and we're getting a bit into the details, which I love, but it's great. I mean, so the advice I give a lot of my companies in the downturn is when there's no capital available, rein in your spending, cut your G&A. And a lot of the advice was don't drill. Literally don't drill. Like if you've got a $5 million market cap and you've got a good project, you already have a resource. A lot of these companies think, I'm in the exploration business, therefore I must drill. And so they go out and raise $5 million when they have a $5 million market cap. They attach a warrant to it. Now you're looking at 150% dilution. They put out good drill results, the market doesn't care because there's no appetite. So my advice to many of my companies was buy versus drill. So first of all, cut your expenses. Think like an owner. And if you're starved of capital and you're a public company, think about the private company next door that you've wanted to acquire for 8 years. They're completely void of any capital. There's no support for them. Maybe you can buy at 5 cents on the dollar instead of drilling at 10 cents on the dollar, so to speak. So one of my key attributes is you want to be behind companies that have significant insider ownership because it changes the paradigm. You think like an owner, you rein in your costs, you wait for a better day, you preserve your shareholder value because you're right. Dilution in this business is the killer of returns. It destroys returns. And if you're not careful about governing that, you can end up with a successful mining operation potentially and a subpar shareholder experience. And that's why I think it's important to have cornerstone investors like myself that are speaking. The managers aren't bad on purpose, most of them. They're just thinking that's their job. I got to raise money. If I don't raise money, no one's going to pay attention to my stock and I'm going to raise more money. But if you've got supportive cornerstone shareholders that can keep the lights on when things are dark, then you don't have to face that much dilution when the sun shines.
Well, I think it's also interesting, companies of a certain size have certain skill sets that they can pay for. So they may be all geologists or, heaven forbid, all financiers. So they need that kind of outside guidance or at least, a conversation needs to be had. Let's kind of bounce back out into the macro, because I think we're going to talk on a sort of more regular basis about investing strategies in certain scenarios. So, high level and maybe just drop down a couple of levels as well over the coming months. So I think that's something exciting for people to look forward to. And we're also going to talk specifically about companies in some of those sessions as well. So that's that. So back up the macro, in terms of the environment that we're sitting in now, how are you advising the companies to behave in an environment like this? Because, everyone's incentivized slightly differently. There's a lot of money around. People get a little, well, I think some CEOs, I've certainly seen some want to take all the credit for what's going on in the market at the moment. In reality, it can be further from the truth. They just happen to be in a moment. I'm interested in how they should behave in this moment. Is it a case of make hay while the sun is shining, or do they need to be a little bit more conservative?
Yeah, I mean, I think the financing window is open for the first time since COVID, probably, realistic. It's the first time I've seen it. I mean, the last 6 years, man, all the companies I've been involved with, it's basically been me dialing for dollars. Maybe 1 or 2 orders from a broker, and then me dialing into my network to try to raise money, literally hand-to-hand combat to raise $5 million. This is the first time where we're seeing, brokers coming to us with $10 million, $50 million, $20 million bought deals. And you're right, pretty much everybody's getting financed right now. And one point I've made in previous discussions I've had is, in these kind of market environments, investors kind of tend to forget about quality. And oftentimes the lower quality names will go up more than the higher quality names. And so, again, back to our earlier discussion about me not being distracted what's happening in the NASDAQ or AI or being patient, I'm less flummoxed about someone's made more money than me in the last 3 months because the lower quality stuff is working. You, as an investor and a company, you want to make sure you're allocating capital, both your personal capital as an investor and as a corporate capital, to projects that are of high quality and don't need $5,000 gold to work. So there's going to be, we're not at all in that crazy phase yet. We're just in the first phase where we've seen financing available. So I'm advising my companies, take the money while it's there, take the right amount of money, but let's stay focused on the high IRR projects that we would have made if gold was $2,000 and not $4,000. That's how you're going to make lasting high IRR investments over the cycle, and not just be caught up in missed capital allocation right now.
It's interesting because I think those are the kind of lessons learned out of the 2020 situation where money was abundant for that year or year and a half. And I say all sorts of companies got finance perhaps shouldn't have, and a lot of value destroyed along the way when they were kind of found out, when the money didn't allow them to continue their dream. So that's fantastic. Gold environment, as you say, it's creeping up there. You want to pick companies that maybe don't need this price to be successful, but at the same time, you've got to be looking forward and going, everything you're hearing suggests this thing's only going to go higher when it comes to gold. And I guess silver as well coming on for the ride, right?
Yeah. I mean, I think if you look at what's driven the gold price, and probably back to our earlier discussion, why the stocks have not done so well is, the main driver of the gold price from 2019 onwards has been central bank buying. Physical central bank buying, which we had not seen in the market for 50 or 60 years. But we had not seen the participation of mainline institutional funds, the hedge funds, the faster money, let's say, that would be typically has driven all the gold rallies since the 70s, which was more of a trade. And so the central banks, they buy gold at 2,000. They're not selling it at 3,500. They have a target percentage allocation. We can talk about that in future interviews, but that's just a sticky, relatively price agnostic buyer, which has been driving the gold market. But the financial buyers have been in a period of doubt or distraction, like we said earlier. We're finally starting to see those investors come to the table, which has added a bit of fuel to the fire. Right? So that's been a key component of the gold price. So I think central banks are going to stay omnipresent. I was reading today. I mean, we knew the stats before this gold rally. 0.5% of total investor capital in the world is allocated to gold. And given how important gold is getting in terms of a monetary metal and importance in the financial system, and the BRIC countries trying to reinsert gold in the financial system, it's hard to believe it's going to stay at 0.5. Maybe it's 1%, 1.5% now with the moving gold price. Still a very modest allocation relative to what I feel the importance of gold is taking back in the monetary system again. So I think you're right. From that perspective, we're still very early, I think, in the adoption curve, both from an investor perspective and its role in the economy again. Short term, you can have corrections. Like, it would be very healthy to have a 10, 15% correction. Back to your point about having conviction and staying power, you're going to see these ups and down rallies, but the macro winds remain firmly at their back. We're in a gold price environment where companies are extremely profitable already at this gold price. We don't need higher gold prices for these to be fantastic equity investments. But I do feel the winds at our back, and I'm not seeing the kind of exuberance. Nobody asked about gold stocks and Uber riding the way here to London here. We're not at that level of folly that you typically see in market cycles. I'd probably say we're in like the third or fourth inning, to use a baseball analogy, of where we are. But obviously the investor interest is slowly awakening, which is a great thing.
I think what's interesting to me is, I think it was on FT this morning, I'm talking about the gold boom. Mm-hmm. So mainstream media talking about gold, so people will start talking about gold. But it's the type of money that's coming back in. Like the mining space is quite small. Mm-hmm. And you know, when most of the institutional investors had sort of faded away over the last sort of 10 years, and we saw an exodus from London back over to North America, and I think maybe they're sort of heading back this way. It's still not a whole bunch of money that you're talking about. But when you get generalists coming in, and we saw that at Colorado Springs, mm-hmm. We saw it even at Beaver Creek, you know, which is normally a kind of smaller kind of conference or smaller company conference. Tether got everyone a little bit excited, physically buying, I think so far $10 billion worth of physical gold, mm-hmm. with another 60 behind it. You've got generalist investors kind of coming in without much knowledge base about how the space is working, and not just precious metal, but on copper and some of the other metals as well. Does that excite you? Because the quantum of money is a factor bigger.
So what really excites me, Matt, one of my companies did a 4.5-day roadshow in Toronto recently. Yeah. And if you look at what that would have been 3 years ago, we would have scraped and fought to get a day and a half with a couple of breaks in between. 4.5 days of back-to-back meetings. And I asked the corporate, well, who are you meeting with? Where are these guys coming from? And 2/3 of the meetings were accounts that never met with the company before. Mm-hmm. But the best news was they were mainly family offices. And I've done a lot of marketing to family offices in my institutional business over the years. And those are family offices that will be buying private equity, buying tech VC, S&P 500. And so that was an incredible news to me, because it wasn't your typical fast money, hedge funds that come in and out based on what the flavor of the day is. Yeah. These were guys that were, systematic allocators, thoughtful allocators. But like you said, I've never looked at gold before. So that tells me that's a great long term. Those guys go, I'm at zero today, and I think I should have 5 to 10% of my portfolio in gold equities. Yeah. They're just dipping, the financing you're seeing, they're dipping their first toes in the water, getting 0.5% or 1% allocation. Yeah. Yeah. So I was really happy to hear that list, that broad diversity. And as you know, a lot of the money today has gone away from institutional to private family office money. Yeah. And those are the investors that have a longer time horizon, are thoughtful about their allocations. They're probably looking at bonds going, I'm not sure if that 60-40 makes sense anymore. Private equity, probably too much money. We talked about the feature interview there, too much money chasing too few opportunities. So they've had a good run in private equity. So what's an unallocated space or corner of the market that they can invest thoughtfully for the long term? I think the gold will start to resonate, and that schedule was quite encouraging to me, the type of investors being met.
Well, absolutely. I've heard bigger numbers than that from some of the banks. I think one of the banks put something out about 2 weeks ago, so 60-40 became sort of 50-30-20. Mm-hmm. And you're like, that dramatically, because the quantum again is the thing that changes the dynamic of this sector. I think it's going to be a while before it kind of trickles down to the smaller companies, but the bigger companies are benefiting from that. The advanced developers are benefiting from that. How long before this kind of cascades down into the kind of the juniors more broadly, in terms of, because the more money it comes down, the cost of that money comes down. Correct. I think that's the exciting bit.
I was talking, you've been following the sector for a long time like I have, but going way back in the 90s, let's say, getting a bit old now, but the gold sector used to trade at significant NAV premium multiples. 1.5 times, 2 times NAV. Yeah. And the thesis around that was always a scarcity value. So when gold has a significant allocation from all these family offices or the pool of available capital in the world, there's not a lot of precious metals equities. So we talk about that, like the whole precious metal mining sector is maybe 1/4 of NVIDIA's market cap. So if that money starts to flow into this space, I think you'll see again premium NAV multiples, like you see in the uranium space. Like, why does Cameco trade at 2 times NAV? Because there's very few ways for investors to express ownership of uranium and leverage the uranium price. Yeah. So Cameco has a big multiple. Well, for decades, the gold equities have now traded like oil stocks or copper stocks, which is like below NAV because of the abundance of opportunities in those spaces. I think those days may come back. And that's to answer your question is, if the large cap names start trading at 1.5, 2 times NAV, well, their cost of capital is significantly decreasing, right? And that trickles down to the next level of companies who have incentive to get bigger. And also, these large companies, it's obvious the business depletes itself every single day. Yeah. You're producing gold, you have to replace it. And these companies have not invested in exploration, not invested in new mines to a large degree. So as they grow and their cost of capital decreases, their appetite for acquisitions and their need for acquisitions will grow. I'm not talking about big flashy M&A like we saw in the last big cycle of 2008, but just replacing the pipeline. Yeah. And for the juniors, the most important metric is cost of capital. Yeah. Because your cost of capital decreases, your dilution decreases, investors get more comfortable that you can finance and move these projects forward and earn a good return. So it's actually a healthy cycle that feeds on itself.
I think so. I think what we've seen is a lot of kind of mergers of equals, and people are very frustrated with that because there's no new ounces in that. But the way that they get valued is, they need the reserve numbers to be at a certain level to kind of maintain their value. But with the kind of juniors, the CEOs of these companies, it's hard to find good groups. Mm-hmm. It's hard to find groups that can sort of take something through to the end. So in terms of the makeup of your portfolio, in terms of companies that you think, they'll get into production, mm-hmm. I think we can do that with them. These guys, maybe they'll exit to a builder, mm-hmm. and these guys perhaps need to exit a little bit earlier. How do you get that kind of the correct balance of that risk profile that you look for?
Great question. It's very rare, Matt. So my initial investment would be a $5 to $20 million market cap. So really early. Mm-hmm. I'm looking at, even at that market cap for the hallmarks, does this company have what it takes? Geologically, infrastructure, all those things to become a producing asset. But you'll never find in a $5 to $20 million market cap junior company the management team that's able to build the mine. Yeah. So there's different management teams for different seasons. You have to understand that. And so through all the Lassonde curve, wherever you are on the Lassonde curve, there has to be humility and there has to be significant board and insider ownership to say at some point I got to hand off the keys or bring in people that have a next skill set. So exploration is very different than, studies, economic studies, PEAs, pre-FS, PFS, to building the mine. There's 3 different skill sets that come along that. And so you either have to add that talent or hand the keys off from a management role or an acquisition perspective to someone that can do that for you. Right. A lot of companies fall into that trap where they think they can do everything, and they don't have the ability to do that. So humility and ownership will be a good governor of that. But the honest answer, Matt, is that it's very rare that you see a junior go all the way from a exploration discovery to build the mine. Usually the high quality assets at some point in the cycle get acquired, because the capital and the expertise and the build teams are also extremely scarce. We talked about scarcity of gold stocks to invest in terms of available capital. The high quality teams that can build mines, most of them are in their 50s, 60s. Yeah. There's a hollow in the industry in that kind of 30 years old to 50-year-old space of experienced mine builders. We haven't built a lot of mines in the last 20 years. So those teams are also going to be at a premium. And so the management teams also have to recognize that maybe you're not getting 100 cents on the dollar, but if you sell at 85 cents, you're going to avoid a train wreck in the future.
Is that part of you, right at the beginning of this conversation, you talked about making sure that you're able to, or you felt you could have a conversation with the management team about, markets. I understand markets, let me share that with you. Do you think in terms of that component, in terms of, look, be humble, be realistic, this is your skill set, is there a kind of a setup period and say, look, we know what you're good at some point you need to hand the keys over to the next group, but I want to stay involved and not treat that as an exit moment. Yeah. I mean,
that's when you're an owner, you think that way.
Yeah.
Right.
Yeah.
If you're an owner, you go, well, in all humility, you have a lot invested in this project, and the company, a specific portion of your net worth as a CEO is invested in this business. You're likely going to seek out the best talent possible. If your main motivation is the salary and the option package and the trips you get to take, and then you're not likely to hand it off to someone else. So ownership is very important, and having supportive shareholders and having alignment from day one on what the strategy is. I think I bring a lot of financial acumen to the table, but also strategic vision. Okay. Saying, how are we going to make money for shareholders? Like what is our game plan from today in the next 5 years? What does success look like?
Yeah.
What are the steps we have to take? I love companies that lay out their objectives each year for investors, so it's very, very clear where they want to be at the end of the year. Because also when you're in a business, when you need to finance with the cost of capital, investors need to know there's stepping stones to higher valuations and value creation. So if you're aligned on strategy and you go through that process systematically and discuss with management where they can drive the company, where they would need help, then you'll be able to add the right people at the right time and know when it's time to broaden out the group.
Okay, well, we've touched on a few subjects there, but not exhaustive by any means. And I think over the next coming months, we'll talk about more of the things that you particularly like to look at, and maybe other investors may like to look at as well. So appreciate your time today. I think we are going to, you will attract a certain type of investor profile, okay? Not everyone's going to want to do this. Maybe people think they can do it better. Maybe some people think that actually I wouldn't mind coming along for the ride here with some of the companies that we'll be talking about over the next few weeks and months. So Mike, I appreciate your time today.
Good to see you, man.
And good luck this week. It's a busy week.
Busy week.